So in our last segment, we talked about converting our up-down to debits and credits. So we analyze the transactions, then we journalize them by converting them to debits and credits, and then we post them. Once all of our transactions are posted to the T accounts, what we can then do in our T accounts is add them up, which I showed you how to do in the previous part, and then figure out what our ending balances are. So we have all our various T accounts for the accounts that were affected for our transactions A through F, and you could see they all have beginning balances, which is the balance at the end of the previous period, and then we record the effect of our various transactions A through F, and we're left with an ending balance. Those ending balances are going to be used to prepare the financial statements for the company. Just as a reminder, remember when adding up a T account, you add up your debits, add up your credits, and then take the difference to get the balance, and the difference goes on the bigger side. So looking at the cash account really quick, just to remind you, $419,500 plus $3,700 plus $2,000 gives me $425,200. $425,200. And then on the credit side, $53,400 plus $4,600 plus $44,000 gives me credits of $102,000. You take the difference, so $425,200 minus the $102, and the bigger side wins. So we put the balance, which is $323,200 on the debit side because the debits are bigger. So all a T account really is like that shoebox. It's what we use to summarize all the transactions. So visualize the shoebox with all your various receipts in it, and then at the end of the period, you add up all the receipts in each shoebox to figure out the balance in each one. That's all T accounts are used for. Once we complete all of our T accounts, we can create what's called a trial balance, and the purpose of a trial balance, like any trial run, is a practice run to determine that debits equal credits. So all a trial balance does is determine that our debits equal our credits, which you can see at the bottom. At the bottom here is true. Debits do equal credits. If our debits don't equal our credits in our trial balance, then we know we made some type of error. Most likely we posted a journal entry incorrectly, or we did the math wrong. That's where I would screw up. And we can then go back and fix it and find the issue before we create the financial statements. Because if we move on and create the financial statements before we do a trial balance and our debits don't equal credits, your financial statements aren't going to balance, and that's going to be a real shit show to deal with. So this is our opportunity to do a little practice run, make sure debits equal credits before we move on to the next step and prepare the financial statements. When we prepare the financial statements, we could prepare what's usually called a classified balance sheet. We went over this before, but that's when we break up our assets into current and long-term. Current assets are the ones that are going to be turned into cash or used up within a year, non-current more than a year, and we do the same with our liabilities. Current liabilities are obligations to be paid within the next 12 months, and then long-term would be more than 12 months. Why do I care about that breakdown? Well, guess what? In order to pay liabilities that are current, in other words, due within 12 months, you need enough current assets to do it. You need enough assets that can be converted to cash within a year in order to pay those liabilities that are due within a year. So it's not enough for a company to have just more assets than they do liabilities. They have to have more current assets than they do current liabilities, or they're going to run out of money in the short term and get themselves into a lot of trouble. To better determine how well a company is performing with respect to its liquidity, which is how easy it is to convert things to cash and pay things off, we can use ratios. So we're going to learn several ratios throughout the class, and the first ratio we're learning is the current ratio. So the current ratio is current assets over current liabilities. What this tells me is whether the company has enough short-term resources to pay its short-term debt. At a minimum, this needs to be 1. So the minimum is 1, and the reason for that is if we have 1, it means for every dollar in current liabilities, we have exactly $1 in current assets. If we go less than 1, it means we don't have enough current assets to pay off those current liabilities, which definitely would not be a good thing. Higher is generally better. Because it means we have more current assets than current liabilities. So if I have a current ratio equal to 1.5, then that means for every dollar in current liabilities, I'm going to use an abbreviation, CL, we have $1.50 in current assets, CA. Whoops. So the higher the current ratio, the better. If the current ratio is 1.5 as an example, what that tells us is for every dollar we have in current liabilities, we have $1.50 in current assets. Most certainly we don't want to have less than 1 for the current ratio because it means we won't have enough current assets to pay those current liabilities when they become due. As with any ratio, just looking at the number on its own isn't very useful. Certainly we can see that it's above or below 1 as a starting point, but we really need to compare ratios over time. So compare this year's current ratio to last year's for the same company, or compare the ratios to industry standards to figure out how our company is doing with respect to its peers. That's the best way to use ratios, doing some type of comparison to figure out if the company is better or worse than the competition, or better or worse than they were in the previous period. The last thing we need to talk about in this chapter is the cash flows related to the transactions that we covered in this chapter. Because we covered balance sheet transactions, we dealt with long-term asset and long-term liability and equity transactions. And if you remember back from chapter 1, investing activities deal with our long-term assets. So when we buy long-term assets or investments for cash or sell them, that would be an investing activity. Lending cash to others, again, would be an investment activity. That would involve a note receivable. Receiving principal payments on loans made to others, so basically, in English, that means getting the money back for the note receivable. All of that is an investment activity. And the reason is when I loan money to somebody else, I'm doing it as an investment. I want to earn interest. Remember, though, that the interest relates to operating activities. So interest received and interest paid are operating. We'll cover operating activities in the next chapter when we deal with revenues and expenses. Because you may remember back from chapter 1, all cash flows related to revenues and expenses go in the operating section. For financing, when we borrow money, that's a note payable. And when we pay it back, that's all part of financing activities. Again, the interest, as I've already mentioned, the interest paid is going to be an operating activity. It's only the principal amount of the loan that goes in financing. When we issue stock to owners, that's a financing activity. When we buy our stock back, which we'll cover in a later chapter, that would also be a financing activity because it all deals with our equity. Paying cash dividends is another one that students get confused on. That's a financing activity because we pay cash dividends to the owners. Dividends are also not required. Therefore, they're not expenses, so they can't fall under the operating category because we said operating deals with revenue or expense related cash flows only. So dividends are not required, therefore they're not an expense. Who do we pay dividends to? The equity holders, so that's why it goes under the financing section, because financing deals with debt and equity transactions. Investing deals with long-term assets. And again, operating is revenue or expense related cash flows. Dividends received would be another tricky one. Dividends received from investments, people want to put in the investing section, but dividends received would relate to dividend income or revenue for the business. So that's why it goes in operating, because any revenue or expense related cash flows belong in the operating section. So there's some logic behind this. Take a little time to practice it and think it through. But ultimately, anything related to long-term assets is investing, because why do we buy a long-term asset? As an investment in the future for the business. Anything debt and equity is financing, because how do we finance those assets, those A's, with L's and E's, with debt and equity? And then what are we in the operation to do, or why are we operating the business? To generate profit. And what's profit? It's made up of revenues and expenses. And that's it for chapter 2. Remember, practice makes perfect. It's going to take a lot of time practicing to understand this material and make sure that you really have a grasp over the various concepts. Practice makes perfect.